Understanding recession and economic recovery. Recessions are periods of significant economic decline marked by a substantial and prolonged downturn in economic activity. These downturns are often characterized by a sharp contraction in GDP, a rise in unemployment rates, and a decline in consumer spending. And the impacts can be far-reaching, affecting individuals, businesses, and entire nations. However, throughout history, some economies have shown that they possess the capacity to recover and regain stability, even in the face of such challenges. In this article, we will delve into the causes of recessions and explore the strategies employed by economies to facilitate their recovery. Causes of recession. Now, recessions are not usually isolated events that happen alone, but rather as the result of complex interactions between various economic factors. These causes can operate individually or interact with each other, which amplifies the impact of a downturn. Let's take a look at some of these causes. 1. Financial imbalances. Financial imbalances occur when there is excessive borrowing, speculative activities, and asset price bubbles in the financial sector. These imbalances can build up over time and eventually lead to a recession. For example, prior to the global financial crisis in 2008, the housing market in the United States experienced a significant bubble. Lax lending standards, subprime mortgages, and the securitization of risky loans created an unsustainable housing boom. When the bubble burst, it triggered a wave of foreclosures and a collapse in housing prices, which led to a ripple effect throughout the financial system, leading to a severe recession. 2. External shocks. Recessions can also be caused by external events that disrupt economic stability, such as geopolitical conflicts, natural disasters, or global economic downturns. For instance, the oil price shocks in the 1970s had a profound effect on many countries. The Organization of Petroleum Exporting Countries, OPEC, imposed an oil embargo, which led to a sharp increase in oil prices. This sudden rise in energy costs strained businesses and households, resulting in reduced consumer spending and investment, ultimately leading to recessions in several economies. 3. Policy mistakes. Poor policy decisions by governments or central banks can contribute to the occurrence or severity of recessions. In some cases, policymakers may pursue inappropriate monetary or fiscal policies that dampen economic growth and stability. For example, if central banks raise interest rates too aggressively to curb inflation, it can restrict borrowing and investment, leading to a slowdown in economic activity. Similarly, sudden fiscal austerity measures such as deep spending cuts or tax increases during an economic downturn can further weaken aggregate demand and prolong the recessionary period. 4. The bursting of asset bubbles. Asset bubbles refer to situations where the prices of certain assets, such as stocks or real estate, rise rapidly and exceed their intrinsic values. When these bubbles burst, it can have severe consequences for the broader economy. The dot-com bubble in the late 1990s is a good example. Speculative investments in technology stocks drove their prices to unsustainable levels. When the bubble burst in 2000, many internet companies collapsed, leading to significant wealth destruction, reduced business investment, and a subsequent economic downturn. 5. Macroeconomic imbalances. Persistent macroeconomic imbalances, such as trade deficits, excessive government debt, or unsustainable levels of consumer and corporate debt, can create vulnerabilities within an economy. These imbalances can eventually trigger a recession when they reach a tipping point. The European debt crisis that unfolded in the late 2000s and early 2010s provides an example. Several European countries, including Greece, Spain, and Portugal, faced severe economic downturns as a result of unsustainable levels of government debt and structural imbalances within their economies. Economic recovery strategies. During a recession, economies employ various strategies to promote recovery and restore stability. These strategies involve monetary, fiscal, and structural policies. Let's explore each of these approaches in more detail. 1. Monetary policy. Monetary policy refers to actions taken by a central bank to manage the money supply and influence interest rates. The primary objectives of monetary policy during a recession are to stimulate borrowing and investment, boost consumer spending, and encourage overall economic activity. Here are some key monetary policy measures. Interest rate reduction. Central banks lower interest rates to make borrowing more affordable, encouraging businesses and individuals to take loans for investment and consumption purposes. Lower interest rates can spur economic activity by incentivizing spending and investment. Quantitative easing, QE. Central banks can implement QE programs by purchasing government bonds and other financial assets from commercial banks. This increases the money supply, and injects liquidity into the financial system, making it easier for banks to lend to businesses and individuals. QE helps lower long-term borrowing costs and supports lending and investment. Forward guidance. Central banks provide forward guidance to communicate their future policy intentions by signaling that interest rates will remain low for an extended period. Central banks aim to influence market expectations and encourage borrowing and investment. This communication strategy helps shape market sentiment and boost confidence in the recovery process. 2. Fiscal policy. Fiscal policy involves the use of government spending and taxation to influence the overall level of economic activity. During a recession, governments typically employ expansionary fiscal policies to stimulate demand, create jobs, and support economic recovery. Here are some key fiscal policy measures. Government spending. Governments increase spending on infrastructure projects, public works programs, and social welfare initiatives. These investments create job opportunities, stimulate demand for goods and services, and contribute to economic growth. Increased government spending has a multiplier effect as it stimulates additional private sector activity. Tax cuts. Governments can implement tax cuts to put more money in the hands of individuals and businesses. Lower taxes increase disposable income, encouraging consumer spending and private sector investment. Tax cuts can provide a short-term stimulus to the economy by boosting aggregate demand. Targeted stimulus measures. Governments may introduce targeted measures to support specific sectors or industries that have been severely affected by the recession. For example, providing financial assistance or tax incentives to small businesses can help them recover, retain employees, and contribute to overall economic revival. 3. Structural reforms. Structural reforms involve policy changes aimed at improving the underlying structure and functioning of the economy. These reforms address long-term challenges, enhance productivity, and foster sustainable growth. During a recession, economies can implement structural reforms to create a more resilient and competitive economic environment. Some key structural reform strategies include labor market reforms, enhancing labor. Market flexibility by reducing rigid employment regulations can encourage businesses to hire more workers. This can help reduce unemployment and facilitate a quicker recovery in the job market. Regulatory reforms. Simplifying bureaucratic processes, reducing red tape, and improving the ease of doing business can attract investment, promote entrepreneurship, and foster innovation. Streamlining regulations enhances market competition and efficiency. Investment in infrastructure. Investing in infrastructure projects, such as transportation networks, communication systems, and renewable energy, stimulates economic activity. Infrastructure development not only creates jobs in the short term, but also enhances productivity, reduces costs, and improves the overall competitiveness of an economy. Education and research and development, R&D. Investing in education and R&D helps foster innovation, human capital development, and technological advancements. These investments contribute to long-term economic growth by driving productivity gains and enhancing the competitiveness of industries. Historical examples of economic recovery. Throughout history, various countries have faced recessions and successfully recovered by implementing appropriate policies. 1. The Great Depression and the New Deal, 1930s United States. The Great Depression, triggered by the stock market crash of 1929, was one of the most severe economic downturns in history. It resulted in massive unemployment, widespread poverty, and a sharp decline in industrial production. To counter the crisis, President Franklin D. Roosevelt introduced the New Deal, a series of policies aimed at stimulating the economy and providing relief to those affected by the Depression. The New Deal included public works programs such as the construction of roads, bridges, and public buildings, which created jobs and injected money into the economy. It also established the Social Security system, which provided financial support for the elderly and unemployed. Additionally, the New Deal introduced financial reforms and regulations to prevent another stock market crash. The combination of these measures restored confidence, created jobs, and paved the way for the United States' eventual recovery. The economy started to grow again, and by the late 1930s, the worst of the Great Depression had passed. 2. The Asian financial crisis and structural reforms, 1997 to 1998 Asian Tigers. During the late 1990s, several East Asian countries, known as the Asian Tigers, faced a severe financial crisis. Years of rapid economic growth fueled by heavy borrowing, speculative investments, and weak financial regulations had created vulnerabilities in these economies. When investor confidence waned and foreign capital fled the region, a severe economic downturn ensued. To recover from the crisis and restore economic stability, the affected countries undertook comprehensive structural reforms. These reforms aim to address the weaknesses and imbalances in their economies, paving the way for sustainable growth in the long run. One key aspect of the reforms was the strengthening of financial systems. Countries like South Korea, Thailand, and Indonesia implemented measures to enhance banking regulations, improve transparency, and increase oversight. They also restructured and recapitalized troubled banks to restore their solvency and maintain financial stability. Another focus of the structural reforms was addressing corporate governance issues. The countries implemented measures to improve transparency and accountability in corporate practices, which helped restore investor confidence and attract foreign investments. Furthermore, these nations encouraged entrepreneurship and innovation by providing support for small and medium-sized enterprises, SMEs, and promoting research and development activities. They also invested in infrastructure development to enhance connectivity and facilitate trade. Recessions are challenging and disruptive for economies, but history has shown that recovery is possible with the right mix of policies and reforms. We've been able to understand the causes of recessions and learn from past experiences that can guide governments and policymakers in effectively responding to economic downturns and promoting sustainable recovery.